But hour by hour, zero DTs, we decided to take a look. Jacob and the team dug deep into this one as far as the
they really got. I was privileged to see this beforehand. They really got granular here with 0 days.
You're going to be surprised by these results because they're going to show you how damn hard it is in an hour by hour basis to make money in the zero DTs by selling premium. But you're going to go, well, then why can't I just buy it? Well, it ain't that easy either. So this is what we call the classic zero sum game. Let's do it. So in the right underlying zero DT markets, they're fast and they're highly liquid. So far, our research has generally supported rapidly managed trades with P&L thresholds. What that means is if you have a profit, take it. No hero crap, as we say. If you have a profit in the zero DTs, just take it, move on. But what happens to traders who stay in for the ride? Because our research has shown that if you're shooting for a 25% profit, you do really well. But if you stay in for the ride, you do really bad. So we're going to break it down. Let's go to the next slide.
And before you go to the next slide, Sadnov, so you can stay there. It's fine. I mean, think about what it's saying right now. You know, this is like 0 days made the product so small, made this huge product. Remember what SPX is. I mean, it's a huge index. SPX is trading, $5,800. It made a $5,800 stock affordable for undercapitalized accounts. They can buy far out of the money options. They can sell spreads. It almost is the opposite of everything that we've talked about for longevity of staying in the market. We've always talked about here at Tasty going 45 days out, giving yourself time to be right, not being very heavy into the nuances of daily movement. This is exactly the opposite here. And they got to take a look at really how this pricing works out here and see where the edge is. That's where they're going with this. So go, please.
Well, we're going to look at everything. We're going to look at 50 delta straddles to 10 delta strangles. We're going to buy it. Now here, you buy it at the start of an hour and you sell it at the end of the hour, or you sell it at the beginning of the hour, you buy it back at the end of the hour. I'm sorry, that's what I meant, because these are short strangles. So you sell it at exactly at like 9 o'clock, you buy it back at 10. You sell it at 11, you buy it back at 12. Okay. Now, could you say, well, would the opposite be correct if I just bought them? Sure, that's fair. Everything is considered to be done at mid price, and just remember, there's lots of times when there's decent profits in here, but because you have to do it hour open to hour close, then that's where it goes away. Let's go look at the next slide. What you're going to see is something very consistent here. These are short straddles. And 8:30 to 9.
So the first hour, because they want to do it on the hour 9 to 10, the first hour is really only a half an hour. So it's like basically if you did it right on the opening and closed it at 9 o'clock.
What you're going to see on all these slides is 11 a.m. to noon Central Time is probably the strongest period because that's where we have the net average P&L is positive. All the other ones are negative, which was kind of funny to me. But the other piece to this is that, the most important piece to this to me is the net average P&L is negative on all these. But if you did it when you took a certain percent profit, which we're not showing here, they were all positive.
That's correct. And so another thing you're putting out here, remember, when you're doing back testing in here, you're talking about mid-price. Mid-price gets to an extreme, like intraday, like you'll see a mid-price because things start hitting the fan. A mid-price goes very, very high and then very, very low. So, these numbers here are, take it with a little bit of a grain of salt. You have no slippage in here. We all know rarely do you get filled at mid-price until something moves one way or the other, and it has to move against you. So you could say that net average P&L is basically zero in my eyes.
Okay. Well, it's negative across the board. But anyway,
I get it at mid-price.
The important thing here is it's not a big number. It's not a plus. It's not a huge minus. It's kind of a scratch. And this is from the short side. The long side would not be too much different, just so you know. And the crazy thing here is that, again, if you managed at 25% of max profit, every single one of these would be a winner. Let's go next slide.
That's correct.
So these are all going to look very similar. These are 40 delta strangles. Again, you're not going to, you can't tell the difference between many of these. The numbers are all going to look pretty close to the same. You go to 30 delta strangles, John, which is the next slide. You're going to see all the numbers look just about the same. The middle of the day is the best, but the numbers will get smaller and smaller as we get further away from the at the money. But the percent profitable, and the net average P&L are almost virtually the same regardless of what we do. Go to the next one, John, which is 20 delta strangles. And you can see it's almost all the same here. Everything's kind of, just all within $10, not much either way, except obviously the worst is the last hour because that's always the hardest. All the percent profitability is virtually the same. The average gain goes down, the average loss goes down as you get further out of the money. If you go to 10 delta strangles, John, which is the next slide, see the numbers, just about the same. I mean, they're just further out of the money, but not a big, then the average loss goes way down. But again, the percent profitable drops here. I'm only pointing this out because, again, every one of these numbers has a positive P&L if you manage early. Let's go to the last slide, the takeaways. So, and here is really good, really strong takeaways. When it comes to zero DTE option positions, each hour, selling at the beginning of the hour and buying it back at the end was most likely a loser over time. Midday was slightly kinder than either the close or the open. Even though each individual hour of trading was unlikely to be a winner, the good hours tended to be more good than the bad hours were bad. And note that all strikes were fixed at market open. More dynamic management may have very different results. In fact, they're all going to be positive. There is no best time for zero DTE option sellers, and these results reinforce the importance of trade management by being persistent and mechanical. Many low probability hours can be combined into high probability trades.